Financial modeling is the process of creating a mathematical representation or model of a financial situation or performance. Typically carried out using spreadsheet software like Microsoft Excel, financial models are used to forecast future financial performance based on historical data, assumptions, and various economic factors. These models are essential tools in corporate finance, investment banking, and various business planning activities. They help stakeholders make informed decisions about investments, acquisitions, capital allocation, budgeting, and forecasting. Financial models can range from simple calculations to complex simulations that include income statements, balance sheets, cash flow analyses, and scenario planning. The process involves understanding and incorporating different variables that impact financial performance, such as revenue growth rates, profit margins, tax rates, interest rates, and market conditions. Analysts use these variables to build detailed projections and run sensitivity analyses to see how changes in one or more variables affect the overall outcome. The primary goal is to predict future earnings and cash flows, assess financial health, and evaluate potential investment opportunities. Good financial modeling requires solid analytical skills, attention to detail, and a deep understanding of accounting and finance principles. Models must be flexible enough to accommodate changes in assumptions and be transparent to ensure that stakeholders can understand and trust the results. By providing a quantitative basis for decision-making, financial modeling plays a crucial role in the strategic planning and financial management of organizations. Building a financial model for a startup is a structured process that involves several key steps. The purpose of the financial model is to forecast the business's future financial performance, which can be critical for securing investment, making strategic decisions, and managing operations. Here's a step-by-step guide. 1. Define your business objectives. The first step is to understand what you want to achieve with your financial model. Are you looking to attract investors, manage cash flow, or plan for growth? Clear objectives will guide the entire modeling process. 2. Collect historical data. If your startup is already operational, gather any available financial data from previous months or years. This includes revenue, expenses, and any other financial statements. For new startups, focus on market research data that can provide insights into potential revenue streams and cost structures. 3. Identify key metrics and assumptions. Determine the key metrics that will drive your financial model, such as customer acquisition cost, CAC, lifetime value of a customer, LTV, average order value, AOV, and churn rate. Make reasonable assumptions based on market research and existing data to build your forecasts. 4. Create revenue projections. Revenue projections are a critical part of the financial model. Depending on your business, this could involve forecasting sales volume, pricing, subscription rates, or other revenue streams. Consider multiple scenarios, such as best case, worst case, and most likely, to understand the range of potential outcomes. 5. Estimate costs and expenses. Estimate all the costs associated with running your startup, including fixed and variable costs, salaries, marketing expenses, rent, and utilities. Don't forget to include one-time costs, such as initial setup or equipment purchases. 6. Develop financial statements. You need to create projected financial statements, including the income statement, balance sheet, and cash flow statement. These will give a comprehensive view of your startup's financial health. 7. Conduct a break-even analysis. A break-even analysis helps you understand at what point your startup will become profitable. This involves calculating the fixed and variable costs and determining how much revenue is needed to cover these costs. 8. Stress test the model. Use scenario analysis and sensitivity analysis to stress test your financial model. This helps in understanding how changes in key assumptions or metrics impact the financial projections. 9. Review and update regularly. Your financial model is a living document. Regularly review and update it to incorporate actual performance data, new assumptions, and changing market conditions. 10. Present to stakeholders. Finally, present your financial model to potential investors or stakeholders. Make sure it is clear, concise, and thoroughly explains how you arrived at your projections. Visual aids like charts and graphs can be very helpful. By following these steps, you can develop a robust financial model that will help navigate your startup's journey. Financial modeling is a critical skill for anyone involved in finance, investment, business, and corporate strategy. There are various types of financial modeling, each serving different purposes and used in different scenarios. The most common types include discounted cash flow (DCF) model, used to determine the value of an investment based on its expected future cash flows. Comparable company analysis (CCA) model, which compares the financial metrics of similar companies to estimate the value of a company. Precedent transactions analysis model, which looks at past transactions of similar companies to estimate a company's value. Leverage buyout (LBO) model, used for evaluating companies that are potential acquisition targets, involving a significant amount of borrowed money. Merger and acquisition (M&A) model, used to analyze the financial aspects of mergers and acquisitions to understand the impact on the company's value. Initial public offering (IPO) model, used to value a company before going public and to set an appropriate share price for the IPO. Budget model, for financial planning and analysis, forecasting income, expenses, and cash flows over a specific period. Three-statement model, which integrates the income statement, balance sheet, and cash flow statement into a single dynamic financial model. Option pricing model, used to value options and determine the strategies for buying and selling them. Sensitivity analysis model, which tests the impact of different variables on a financial model's outcome, providing a range of possible scenarios. Each type of financial model has its own specific use cases, methodologies, and assumptions, making it crucial to choose the right one based on the analysis required. Understanding these models aids in making accurate financial predictions, decisions, and strategies.